Today, we're deep diving into long-term conviction-based investing with someone who's built one of the strongest reputations in research-driven equity analysis. Welcome to the pod, my friend, Mr. Stock Market Nerd, Mr. Brad. It's a pleasure to host you.
It's a pleasure to be here, man. From the snowy Detroit, so not enjoying the scenery like you are, but good to be here.
Hey, it's okay. Listen, on the pod, they can't tell that I'm in 80-degree Puerto Rico and you're in snowy
Exactly.
Detroit. We're equal manners in this area. So you're the founder of Stock Market Nerd. You know him for a lot of things, but specifically, I would say your meticulous breakdowns, your earnings coverage, and your long-term fundamental-based research. And of course, very widely respected across FinTwit. I found you many years ago when I first signed up. I think you were one of the first 20, 30 people that I followed, and I really enjoyed your research, had a chance to talk with you, and then have really just followed the journey. You've since then built a very strong base of followers yourself, subscribers to your weekly research. So let's dive a little bit further into this. To get us started here, I think it'd be helpful to get some background on what we're going to be talking here and really the highlights of this conversation for everyone that's watching, the main things I want to touch on. Brad's long-term philosophy, how he performs deep research, the lessons learned building a portfolio with conviction, his path into markets and building stock market news, and then, of course, just anything else that comes to his mind during this time period. So with that being said, let's go to the start. What originally pulled you into this world of investing?
Yeah, I've always been really into and maybe like turned on by like risk reward and probabilities and statistics and kind of skewing the playing field ever so slightly in your favor to not guarantee success or not fortify certainty in any kind of outcome, but to like tilt the scale a little bit in your favor so that when you're lucky a little bit more frequently than everybody else, or when things go your way a little bit more frequently than everyone else, you can kind of hang your head on that research that you did, that hard work that you did, to kind of position yourself to know things, so that you know how to react when things are going well or things aren't going well, stuff like that. But I would say it didn't start in a super healthy and sustainable way. I mean, it was probably around 2017, 2018, and in undergrad, and just being bored during the day, and loved watching sports, and there's no sports on. What can I bet on? Oh, these options things are pretty cool. And then fortunately having no money at that stage in my life. So I mean, I don't think there are very many stories that start like that and end in. And I made a lot of money trading options.
That's
so I
$1 million.
no, and so I did not do that. But I really kind of cultivated a strong interest in financial markets as that was happening, and leaned on mentors and people in my life to kind of reshape the way I thought about things, and to kind of position myself to be able to do this for a very long time in a healthy and sustainable way. Still kind of pulling from the things that kind of inspire me and motivate me, maximizing risk reward, making sure that playing fields tilted in your favor, those kind of things, but doing so in a way that's actually replicable and sustainable and durable.
So you started with options, transition over to something more sustainable. When did this become, I like investing, I'm learning about this, to this is what I want to do?
Yeah, I'd say the pandemic. I was working at a registered investment advisor in Metro Detroit, and it was. I mean, I learned a lot. Met a lot of great people, and nothing at all bad to say about anything there. Just when remote work hit, they weren't super well positioned to give us productive work to be doing. So I was doing a lot of thumb twiddling and really bored. And as my work, honestly, interestingly enough, my work was reading and listening to very, very long presentations and distilling them down into things that my bosses could read so that they didn't have to do it themselves. So not that dissimilar from what I do today in the newsletter in terms of reading really lengthy earnings reports and giving you what matters.
Right.
But from there, just what do I do during the day? The stock market thing's pretty cool. What's this company called Motley Fool? Like I'll apply to be a writer for them, and did that for about a year, I think, maybe about a year, and just really wanted creative control over titling practices and messaging and tone and all things like that. So while I was at Motley Fool, just very big accounts that people respected and that I respect a lot. Brian Frolde is the one that comes to mind. Just really helped get the ball rolling in building the follower count and giving me an opportunity to kind of branch off on my own and see if it could work. And 5 years later, here we are, and it's working. So we'll see if it's still working tomorrow, but right now it is working.
Yeah, I'll give a shout out to Brian. He's coming on the pod in a week or two. So looking forward to that. Another conversation around long-term investing. Obviously, a great mentor. Did you have any other influences or mentorships that really helped you?
I would say my dad. I've been really blessed with great parents. I mean, I'm 28 years old, so to be 5 years into running a business, 23-year-old kind of, I mean, 28-year-old, I'm going to feel like a chicken with my head cut off in 5 years. But right now, looking back from in my perspective at 23, I was a chicken with my head cut off, and just um, leaning on someone who's built a business for 30, 40 years, like he has, and done so very successfully, and done so without drama and doing things the right way, um, and all those good things that I respect. It was very useful for him to allow me to avoid a lot of stupid mistakes and to accelerate the learning curve so that it wasn't so painful getting from point A to point B. And I guess that's what parents are for. And he kind of cooperated as parent slash business partner slash advisor slash consultant slash all those things, and really just helped a lot. And then honestly, just being totally real, my mom is an attorney, so her ability to help me with the LLC at the beginning, sidestep another large legal fee to get things rolling. I mean, it takes a village. So we're here 6 years later, and things are going well, and people like, how did you do that? And it's definitely not just me putting my head in the stand and working on my own. I had a lot of great people in my life and a lot of great resources that got me here a lot more quickly than I would have gotten here on my own.
Yeah, there's I like to say you can either bang your head against the wall for, an hour and figure it out yourself, or talk to someone for 30 seconds who's done it before you and get the knowledge. So it
Yeah.
can go a long way.
Yeah, I love that.
You mentioned, options being that first kind of learning lesson. Were there any other, learning lessons in the investing world in the early days that shaped your style of investing?
Oh yeah. I think I went from very, very like at the very beginning of my investor journey, very buttoned up, um, value oriented, low PEs. Like let's look at a spreadsheet of regional banks and who has the lowest PE. Let's start like that. It was very simple, very um, yeah, extremely simple. I think that was the word I'd use for it. And I think looking back now is if your thesis is it's cheap, well, a million people have discovered that it's cheap before you, and it's still cheap.
Right.
So is there a reason that it's still cheap? But I think um, just reframing how I think about valuation, going from deep value oriented investor to hyper growth investor, where drank a little bit of the Kool Aid in 2021, and um, definitely learned some lessons, and will continue learning lessons my whole life. But going from deep value to hyper growth to kind of this peg or price to earnings to growth multiple oriented framework, where I'm not so much focused on what you're paying for next 12 months of earnings. Well, I am focused on that, but also very much so focused on how much is that earnings number going to grow over the next 1, 2, 3 years. How
Right.
are expectations trending? Are they falling, which hints at them a higher likelihood of them falling more, and vice versa. So really just focusing on um, durable profit growth, and seeking that out at a fair price. And fair price, I think, is a very important thing. I'm not an active trader, but it's very much so an active long term investing mindset. With if something goes from 30 times earnings to 90 times earnings, and the story stayed exactly the same, I'm probably significantly lightening up, because forward risk reward has gotten worse. And if it went from 90 to 30, and I liked it at 90, then I'm probably going to be leaning in, barring some large fundamental change in the story. So yeah, it's I constantly evolving. I think an open mind is super important for us. And just a willingness to change and not be stubborn and evolve is super important. But I think um, process and routine is also very important. So it's a process of just continuously refining that, and making sure it works for me personally, and making sure I'm leaning into the things that are working, and listening, and when there are things that aren't working, and leaning away from those things.
Yeah, very interesting. Sounds like the journey's changed a lot, going from the original, value to higher
Yeah.
growth, finding some of like, hey, like I found this specific metric is what works best for me. So just continuing to adapt and adjust into those areas. We've foreshadowed a little bit here, but the goal is long-term investing, right? And you're talking about high conviction, long duration plays. Can you give me your definition of long-term investing?
Yeah, I think, and I'm stealing Buffett's definition of long term investing. It's that a lifetime holding period is the ideal outcome. That's what you are. That's what you hope. That's the best possible scenario, where Company continued executing, they continued meeting their promises, they continued delivering that durable, profitable growth at a reasonable price, and kept you in, gave you no reason to sell. But that is so rare. I don't think I don't think there's going to be a company that I hold for my entire life, because I mean, sometimes fundamental story deteriorates. Sometimes the price attached to that fundamental story is just no longer compelling, and divorced from reality. I mean, we cycle from, especially now, it feels like just cycle from extreme fear to extreme greed over and over and over again. So taking advantage of that in terms of getting stealing another Buffett quote, greedy, fearful, fearful, greedy, is just skating, almost kind of skating where the puck isn't going, in terms of sentiment, and kind of zigging when others zag, and when people are ready to throw up babies in the bathwater, just really dispassionately evaluating whether this is also bathwater, or if it's an infant that needs to be taken care of and cultivated. Or do you cultivate infants? I don't really, I'm not a parent, so so
There
I
you
don't
go.
think that's the right word, but it's okay.
He's a farmer.
Yeah,
Uh, I hear exactly what you're saying, and I think we all know it's a little easier said than done, right? Things get volatile, and you start looking, right? And you're like, tell me I shouldn't, short these quantum stocks. Tell me I shouldn't do this. And so you do make a lot of tweets about it, sometimes comically on the timeline. But talk to me about the principles that keep you anchored, let's say, when the markets get very irrational.
it's just it's acknowledging that I am a person, I'm a human, I have emotions, and not robotic, but trying to trying to acknowledge that, and make myself act in an almost robotic way, in an emotionless way, where I think it's important to acknowledge that we have these temptations, that it's really hard to be disciplined, and to always do the right thing, and to always stick to your process when you see a pre-revenue company going to $25 billion market cap with a science experiment of a product suite. It's like, do I break the long only rule and take advantage of that? And obviously, if I do break the rule, it's not going to work. But if I don't, it would have worked. So, but I'm just kidding. But it's super. I think super important just to understand that we are human, and that this is hard, and that keeping our mind in the right place is hard, and it's not permanent. It's not consistent. But I mean, it's almost. I took a meditation class in undergrad, because I saw, well, I could take a meditation class for credit in undergrad, and just it's almost funny that the lessons that stick with you in school, it's not from calculus, it's not from econ 402, it's from meditation. It's like, when your mind wanders, just acknowledge that it's wandering. Don't get pissed off that it's wandering, but put it back in the center, and put it in intentionally focus on the things that you should be focusing on. And I think for me, it's the Peter Lynch quote. It's not IQ, it's EQ. It's emotional acumen. It's we're all smart enough to do this. We're all smart enough to do the arithmetic and memorize the vocabulary and the lingo that it takes to be a fundamental investor. But not all of us are able to kind of just keep that emotional acumen in check, and really make sure that we're not acting impulsively, and that we're sticking to our process when it's not just easy to stick to it when everything's working, but when everything is not working, and when it's hard. So human emotions, it's almost a battle against that. It's almost trying to be that robot, but knowing you're going to be a human, and forcing yourself to be the robot anyway.
Was meditation your favorite class?
Yeah, I got two graded credits, and honestly, the professor was such a sweetheart. She was like this. She was this lady in her 70s, Martha. She was so friendly and so sweet and so passionate about what her subject was, meditation. And I think whatever image of her you have in your mind right now is probably perfect. She was just this, like, she was a meditation guru. I looked at her, and I knew you do meditate, you do meditate or yoga or something like that. But she was my favorite professor, teacher I've ever had. I think she was awesome.
This feels like a classic, like honors course. Yeah, that's where they start
Not
doing notes.
quite, not quite, but yeah, I felt honored to be in the course.
There you go. I had a class in college that was studying the show The Wire in Baltimore, and our homework was we would watch episodes of The Wire and then write about money and power.
That is awesome. That sounds
So
awesome.
you never know what
Yeah.
you're going to live. Live and learn. Okay,
Yeah.
so we talked for a minute beforehand about, hey, the process has changed over time, right? Went from value investing to different methods, and then we also just talked here about, there's going to be volatility in periods of time where things are tempting. So how do you balance patience with being willing to change your mind when facts change, markets change, your style changes?
Yeah, I think it's separating the discussion into 2 points. It's how is stock price and stock valuation trending, and how is company performing. And I know people who start doing this in their minds, and rightfully so, it's counterintuitive to think company performing very well, but stock performing very poorly. And so there's got to be a reason that stock company isn't actually performing well, and the stock knows better. But it's not. It's just not the case. I mean, stock markets and stock prices and these ticks that we pay such close attention to. It's people or algorithms on the other side of deciding what something is worth and transacting over and over and over again. And sentiment is sentiment can carry a lot of powerful momentum. Where if it's good, it can get way better than it should be, and if it's bad, it can get way worse than it should be. And it's just really, again, dispassionately and trying to be that robot to emotionlessly evaluate: is the company doing everything it needs to be doing? Okay, are they getting punished regardless? Then maybe buy a little bit. Are they getting have they been rewarded fairly for that? Has the multiple doubled in 9 months? And now maybe it's time to, yeah, company's still doing really well, but now they're actually getting credit for it. So multiple expansion, that amplifier of forward returns probably won't be as powerful as it was over the last year or so. It's just fixating on the company, and then just kind of periodically checking on the stock to see if that forward valuation and that price action has divorced from company performance, which can happen for a few years, and just I like to think of it as kind of a coiled spring where profits growing, revenues growing, market shares trending up. It's a healthy company, balance sheet's good. The multiple is not going to contract forever. The price is not going to continue going down and down and down while earnings go up and up and up. And as that plays out, it is like you're pushing down on that spring and waiting for your hand to kind of come off of it and let it explode higher. But timing for that's always uncertain, which is why it's so frustrating sometimes to be a long-term investor, because we can feel wrong for 4 years, and then 2 months later we made 5 years of average returns in 2 months, and now it's a good position. But it is really making sure we're being honest with ourselves about: is this company doing what it needs to do to continue deserving my time, attention, and money and support? And if it's not, I mean, this isn't the kid. It's not your spouse. It's not your best friend. They don't deserve any unconditional support or loyalty from us. So it's really being that cold evaluator of: are you continuing to earn it?
Got it. So this is all part of the research and discovery process, right? And it's a continuous process that is ongoing. Let's walk through the full workflow. So how you go from discovering a business to building conviction that gets you to full position.
Yeah. So I think so. Right now, the next deep dive is going to be on Axon. So I guess probably just a good example of how that works. So I like looking at companies before I've decided I want to own them. I think I should. I don't think it's a good idea to start a research process with your mind already made up about, yes, I want to own shares in this company. So just for full disclosure, full transparency for your listeners, I don't own any shares in this. I have no idea if I'm going to own shares in this. I'm a week into the research process, and I have a lot more work to do. But really, it's a few things. First, it's more not it's more qualitative research on just making sure I deeply understand their product suite, how they all tie together, what the growth vectors are, what the competitive landscape looks like for each of these products, what market share trends look like, what the runway looks like, and how tapped that runway is, how much longer do they have to grow into their current shoes, how much optionality do they have to add very adjacent and related shoes that they can grow into after these other shoes have been grown into. So just really familiarizing myself with the product suite to make sure if there is if one of the products isn't doing well, or if there's a risk that's surfacing, I'm going to have a great chance of understanding that more quickly and knowing what's real and what's noise, and what to worry about and what to maybe brush off. And from there, and I really like to, I mean, I love primary sources. So the next step of this is going to entail just reading a ton of company information. But before that, I love reading from people in the field who don't have a vested financial interest in saying
Hmm.
Axon has an amazing or Axon has a terrible product. I love like Gartner and Forrester and IDC and all these third-party research firms that will give you these great competitive landscapes, and just here's what they're doing well, here's what they're not doing well. And yeah, they are getting paid to form these reports, but they aren't Axon IR, so it does feel like a step removed from that extreme bias and that extreme subjectivity. So definitely not objective, but getting as far away from company as you can. Maybe not so far as you're reading. You're reading, I guess, just other Substack articles from people you don't
Sure.
know, and
Sure.
kind of just trusting them and what and
Michael
before
Burry.
Yeah, before, but yeah, who even is that? But 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 yeah, from there, product suite familiarized. If somebody asks me what Axon does, I can answer that in a very concise way. That it's the Albert Einstein. I could explain it to an 8-year-old because you actually understand it yourself. But from there, it's going through probably about eight, and this is a very tedious process. Like their last 8 quarterly filings and earnings releases and shareholder letters and conference calls, because it, they cycle through. I mean, there are themes from quarter to quarter where you're going to miss a big focus area if
Right.
you listen to one earnings call and don't listen to a lot of them. But when I listen to 2 years of earnings materials and investor days from this company, you really get a full picture of their puts and takes in their financial engine. What matters, what's driving them, what are sell side analysts worried about and want to look better. Because I mean, the Q&A is a great hint of that. They will, I mean, the Q&A analysts will routinely give you, here's what our credit card data is looking like that we spent a ton of money on, but here you go. Now, what do you think of this? And so it's just, you get so many nuggets from these investor conferences and these earnings calls and these investor days that to fully understand what an investment case and to fully understand if there's this intimidating risk that surfaces tomorrow morning, do I get excited that the stock fell, or is that warranted? And maybe it's time to get a little worried, and that's pretty real, and maybe the story changed. But there's a lot of reading that you need to do to get there. And I know people say, well, just do Gemini or do ChatGPT and read that 3 or 4 paragraphs, and I think you can get a decent amount of the way there doing that. But when we're trying to differentiate around the edges and trying to outperform by a percentage versus a benchmark of 100 companies for 10, 20 years, I think just especially in the age of AI, a willingness to work hard is going to become increasingly unique and increasingly rare. And I think an increasingly powerful source of competitive differentiation versus everyone I'm trying to outperform. So if I can get 95% of the way there with Gemini in an hour, or I can get 100% of the way there with myself in 3 weeks, I'm going to get 100% of the way there with myself in 3 weeks. And I really do think that 5% is important.
Very interesting. A couple questions off that, but first off, you mentioned Axon. So, what was the signal that told you, hey, this is the company I should go do a deeper dive into?
Paid subscribers bothering the sugar honey iced tea out of me to start reading about it. No, honestly, I'm not even kidding. But there were, what I'll do is I will, like for a company like Axon or a company like Spotify or these companies that aren't in the core coverage network, but I am impressed by, I will just continue posting very surface level earnings coverage to keep track of numbers, so that when something like Axon goes from $900 a share to $500 a share, I wasn't ready this time just because timing didn't work out very well. But I want to have done all of that research before that happens, so that I know I'm not in a position to evaluate that opportunity right now, which is a little bit frustrating. But I want to know if this is something again to take advantage of or not to take advantage of. But so it's a combination of, I will there's a heavy filter personally where I will give subscribers options of companies that I'm willing to kind of look into and willing to study. Like if they ask me to study Open Door or a quantum computing company or something that's just um, maybe not, just something that I'm not going to, like I circle of competence, all those things matter. And maybe focusing on things that I think in a higher quality way, but then giving them an option between these 4 higher quality companies, that which one do they want, and they picked Axon. So that's what I'm going to write about.
Got it. Yeah, listen, hey, you got to listen to the people that pay the bills. Makes sense
Absolutely.
to me. I guess then a couple pieces off that. One, maybe this is a quicker one. Do you utilize technical analysis at all in your methodology? I know there's some long-term investors who will look for, simple things like 200-day SMA or something like that.
Yes. Major moving averages, major, like just, and it's just, TA for me is a very elementary. Not, TA is not elementary, but the way I do it is a very elementary. Like, oh, it's falling into a place where it's bounced on heavy volume 5 times, so maybe that's a decent support area. Or oh, it's bouncing off a moving average and that's provided support a few times. So it's not so much the chart's broken, so I'm not adding, but
Right.
it is a, well, the chart looks really ugly, so maybe I should go a little more slowly, and leave myself a little bit more flexibility while this thing repairs in the eyes of the TA, of our TA friends. So it's not kind of a yes or no deal breaker or decision maker for me, but it's a how big and how aggressive do I want to get. That does play a role. If just something just looks like a falling knife, maybe instead of a 20% ad, it's going to be a 4 or 5% ads, and try to space that out in increments if it keeps getting uglier.
Got it. And then on the AI side of utilizing it as a tool for research, have you found any pieces there? Because it sounded like you were more like, hey, I'd rather do the
Yeah.
long route and do it myself, make sure I'm right. Like, could you use it for culminating these reports? You're like, hey, go out and find me all these reports, and then you actually read the reports yourself, or different pieces like that.
Yeah, I think for me, I do. I'm a daily active user of Gemini, so I don't want to. I don't want to stick my nose at AI and say it's stupid, because it's so valuable. But I mean, hallucination rates on these models are still at like 20-25%. So for me, that is so uncomfortable relying on it to give me accurate information. 4 out of 5 times it's going to say something incorrect, and I'm going to look like an idiot because a model gave me the wrong thing, and we're a long way from that not being the case. So for me, I'm pretty sure I know what the right answer looks like. I'm pretty sure this is a good explanation. I'm pretty sure I just articulated this well. Hey Gemini, am I an idiot, or does this sound good? And that I feel like, if you and I like to ask Gemini and ChatGPT and Perplexity most of, and Grok, sorry, for our Twitter friends most of the time, because they are wrong a lot. So I want to make sure, if this
Yeah.
is really important, I needed to get this 100% right. If Gemini says it's right, but that's when they hallucinated, I need to make sure ChatGPT says it's right, and Perplexity says it's right, and Grok says it's right, because there's a much lower chance that they're all going to mess up that query, 4 times. So for me, it is a I've done all the research. I'm not a cybersecurity specialist who knows how to stop 0 day attacks and does that for a living. So please, I said this in a way, and I'll always preface this with, I'm not. This is not for software engineers. This is not for people who need to understand acronyms and lingo. This is for an investor community that needs to understand the investment case and what matters and what doesn't. Is this 100% accurate, or do I sound stupid in any places? And there, I think AI has been extremely valuable for me, gaining confidence in kind of more quickly expanding circle of competence, and more quickly gaining and needed information to offer more valuable opinions in some places.
Yeah, ChatGPT is like, this company made $500 million in profit last year. It looks awesome. And you're like, ChatGPT, this company lost 500 million. It's
Yeah.
like, oh, you're right.
Hey, my bad. It's like, okay, well, I don't. So, do I ask you this follow up question, or like, what are you
Yeah,
going to say?
yeah.
Yeah.
You're correct. On
Yeah.
second thought,
Oops.
yeah. Whoops. How do you recommend just retail investors in general just filter out noise, hype, narratives, stay grounded?
Yeah, I think your Twitter. I'm assuming that most people listening to this are on Twitter or Threads or some form of social media. That can be one of your most valuable tools, or that can be one of your biggest enemies, depending on how you use it. If you follow people like Wolf Financial for relevant, timely information, it's going to be valuable, and it's gonna you'll learn about things more quickly, and you'll be more in the loop. And there will be this random person who somehow got access to these 7 reports they should not have access to, and they decided to publish them on Twitter, and now you have thousands and thousands of dollars worth of research and information that you never would have had. Like Twitter provides things that are so valuable, but it also provides 9 things that are so distracting for every one valuable thing. Not 9 to 1, 2 distracting things for every one valuable thing it provides. So I just think curating your follower feed, and maybe even if you love sports and you love politics and you love stocks, maybe have 3 separate accounts for sports and for
Mm,
politics and for stocks, because you want your For You page to your For You page can get so toxic and so upsetting so quickly, if you're clicking on things that aren't related to stock markets on under a certain account. So just making sure that your Twitter account is your stock market Twitter account, and you are interacting and engaging with stock market content, so that when you scroll down your feed for relevant information, you will get way more of that relevant information. You'll still get a lot of BS, and you'll still have a lot of things to ignore, but you'll get a lot more of the good stuff. So yeah, I think Twitter is super valuable when used correctly. I think it's amazing for inspiration and terrible for unconditional following, kind of thing.
for sure. Speaking of great timeline content, you are becoming very well known for your earnings report analysis. what are the most important things that you look for in a quarterly report? Because you do take a lot of those things and kind of summate them.
Yeah. So different companies. So for one company, the best metric on a financial statement can be the worst for another. For a company like Uber, um, their equity portfolio means net income is totally worthless. It's like they're going to mark to market their grab holdings and whatever else they own in that portfolio, and that is going to power either a large net income beat or a large net income miss, and it's just something to tune out. But for a company like Microsoft, net income EPS is an extremely valuable metric. Arguably now more valuable. Yeah, I mean, counts for depreciation, all the important expenses that we're focused on right now. Without, well, actually, they also have an equity portfolio that's now being marked to market. That's now creating the OpenAI deal that they had is now creating a lot of weirdness in their own net income and EPS that makes that less valuable. But the point is that there are companies where free cash flow is the best metric, like an enterprise software that metric works really well in a lot of places. But then if you look at like a lender, for example, and want to use free cash flow, well, if that lender decided to convert $1 billion in cash on their balance sheet to $1 billion in originations for more business to generate more revenue, that's $1 billion in cash burn for the way some companies calculate it, like Mercado Libre. And more nuanced, some companies calculate it in a different way and don't count that as cash burn. But for a company like Mercado Libre, that makes free cash flow an extremely noisy and extremely misleading metric, because we're basically saying penalizing them for negative free cash flow growth because they're deciding to grow a financial services division and lengthen their growth runway over the next couple of decades. And right now, there's a lot of front-loaded provisioning. I don't need to get too into the weeds or the details.
Yeah.
It's a cash drag right now, which makes it less valuable. So and then sometimes sometimes we're focused on companies that don't even have profit, real profit, and you have to focus on sales or gross profit until they mature to a point of having EBITDA. So these strange items for different companies make some metrics really good in some places and really bad in some places. But I guess for a general rule of thumb, either free cash flow or net income or operating income is probably going to work really well for the company.
Got it. Got it. So it'll be one of the different items, and usually you kind of highlight that item in
Yeah,
your
like
analysis.
if their tax rate tripled year over year, or if foreign exchange led to massive losses, or something just very ephemeral that's not going to be recurring in every quarter, I think it's important to strip that out or highlight that
Yeah.
it had a big impact.
Last question on this research area, and this is kind of a two-parter, and it's really how much do you evaluate management and what traits do you look for within them? And then kind of in tandem with that, how do you think about competitive moats currently in 2025 and what actually matters?
Yeah, team is so important. I mean, we're public investors. We all have access to more or less. We have access to the same information. I mean, we don't have BlackRock's database or anything like that, but we have the same earnings reports. We have the same conference calls. We have it all. So a big source of outperformance or underperformance is picking trustworthy leaders and trustworthy CEOs. Of if you tell me things are going to go, if you give me an investor day target 2 years from now, are you going to hit? Am I confident that you're going to hit or exceed that, or am I kind of thinking to myself, yeah, okay, we'll see, kind of thing. So when we are reliant on leaders telling us the right things to either make money or lose money, picking people with just ironclad morals, great track records, ideally long track records in public markets where they've shown you an ability to just play the extremely shallow game of beating and raising and making Wall Street happy. So that's extremely important. When I cannot rely on something a CEO is telling me, then I cannot invest in their company, because nothing they say means anything. And that forward estimates don't mean anything, because who the hell knows if they can be relied on or not.
Yeah,
Oh, and
I
the
think that's a
competitive
great.
modes. I'm sorry. Yeah, go
Yeah,
ahead.
the competitive mode, and maybe that ties in with leadership, or there's other pieces that you look at.
Yeah, I think mode is an extremely overused term, but when it's real, it is. It is. It's like that. I'm thinking of a Jerry Seinfeld reference, but when it's real, it's spectacular. Like it is. It is. It's pricing
They're
power.
real and they're
They're
spectacular.
real.
Yes,
It's
yes.
pricing
Another
power.
reference.
It's competitive differentiation. It's lower incremental fixed costs. It's like any kind of competitive differentiation like that where I provide more value for somebody else, or I provide the same amount of value for a lower cost, is so incredibly rare and so incredibly important. Because I mean, if it's not in place, I mean, King Amazon or King Google are going to come knocking and take your margin and take your business and take your market share. And
Yeah.
unless you can defend against that, which is really hard to do, either you're going to die, or your margins are going to slowly erode, which is going to kill profit growth, which is going to be penalized and hated, and make your stock not work as well.
Fair. Who's your favorite CEO?
Ooh, who is my favorite CEO? I Who is my favorite CEO? My fiance is CEO of our family, so I
Mm,
probably could say her now. But um, maybe I'll go with like Anthony Noto. I think he's had 5 years in public markets of the entire banking community telling him he's a snake oil salesman and that he's full of it and that he's wrong and that his balance sheet's going to explode and that his fair value markings are BS. All these, again, don't need to go into details, but just not trusting someone who so clearly deserved trust, who just had done everything. Student loan moratorium, 5 points of rate hikes, regional banking crisis. Yeah, it doesn't matter. We're gonna meet the promises that we set forth 3 years ago, despite all of that. So I just think it's a matter of he doesn't have some amazing business model or industry where you can create an obvious competitive differentiation and stand out. And the way they've created a cost structure advantage, which is really in a commodity like banking, that's how you stand out most meaningfully. The way they've done that via owning their tech stack, cutting out branches, owning their charter, merging the strengths that legacy incumbents enjoy with the strengths that disruptors enjoy, and uniquely having both of those, he's created such a defensible business model in an industry, in a sector where you really shouldn't be able to create a very defensible business model where you can have pricing power, where you can have this really durable, smooth growth across cycles. Like it's a bank. How did you guys grow smoothly throughout 2022 and 2023? They said they weren't going to, but they did anyway, because when he says something, he's either going to do that well or even better. So it's just I've had 5 years of me being screamed at by bank analysts who clearly know better, saying that he's an idiot and I'm an idiot for trusting him. And I don't know. Here we are. I don't feel like an idiot today. So thank you, Anthony Noto, for making me look smart.
have you spoken with him?
He is one of the I don't so I know better than asking for a podcast, because I know he gets 50 of those questions every day, and he
Yeah.
kind of his mindset is, if I do one of them, then I have to do all of them, and how would I pick the one? But he is one of the executives where if I have a question in his Twitter DMs, if I'm not asking for any inappropriate things, which I never ask for, then he will give me a response and candid information that I can share. So it's nice having him and a few other of those CEOs, like an open line of communication. I won't say I have 50 of them open line of communications, but there are 4 or 5 where I can pretty reliably get a response from them if I need to. Hopefully, I will have 40 or 50 of them in due time. But yeah, that is nice.
That is cool. That is cool. Let's talk a little bit about the actual portfolio structure and management. We've gone through all of the methodology, but let's talk about the actual make of the portfolio. Maybe you could just walk through kind of the general holdings allocations that
Yeah,
you're
I can't get into specific names because I have to save that for subscribers. But I will say it cycles between about. I mean, there's no rule for this, which is why. But it had for the last. I've noticed for the last 3 years, I've been between 18 and 22 holdings. And what I really like to do is there will be anchors, blue chip anchors at the very top, where best in class companies, large caps. I mean, there's probably a group of 12 10 20 companies in everyone's mind, and they're, I'm sure it's inclusive of those companies as well. But I don't classify myself as a growth or a value investor anymore. There are blue chip turnarounds. There are Wall Street darlings that are just giant profitable compounders that should keep growing as far as the eye can see. But then there are, I do invest in disruptors, and some of the biggest outperformance that I've enjoyed in markets has come from sticking with these disruptors when the world was ready to hate them. And I guess I said Anthony Noto is my favorite CEO, so you could probably decipher that SoFi is one of those disruptors in the portfolio. So companies like that, where I'm not going to give you 7-8% of my portfolio to start. Like that's not going to happen for a company like SoFi. But I am very interested in letting you grow into that and letting you prove yourself over a few years, like they've done, letting me consistently be able to verify and confirm over and over again that, yeah, you're doing everything you need to do for me to be a happy, confident shareholder. So in 2022, 2023, when it's chopping around at $6 a share, infuriatingly, while everything else is going higher, you just infuriatingly is the human in me talking, and then getting back to that idea of just trying to acknowledge that I have those emotions and trying to acknowledge that those emotions are not productive in terms of applying them to your investing process, and instead trying to be that robot. So it's a mixture of these big established companies that anchor the portfolio, and these emerging companies that get smaller bets, but that I'd love to turn into that I would love to blossom and turn into anchors on their own, if they prove to me through years of great operating, years of meeting their promises, years of not no drama, no disappointment, because that's not realistic, but just a lot more success than drama and disappointment. Then they kind of grow into that on their own, and I'm very comfortable with letting that happen. But it's also just getting back to the idea of valuation, making sure that if something's going to grow from 3% to 10% of a portfolio, just using purely random hypothetical numbers, for me, it's not because the PE went from or their earnings multiple tripled or doubled or quadrupled or doubled, tripled, quadrupled. It's because that E in PE, or their free cash flow, or the operating income, is growing in tandem, and the company is continuing to fetch a fair price, or a compelling enough price to continue warranting, in my mind, positive risk reward, and keep being okay with it becoming a larger and larger piece of the portfolio.
Got it. You answered a lot of my questions there. One question, and you can tell me whether you want to answer or not. Keep it for the subscribers. What's the general return of the portfolio look like this year, last few years?
Yeah, so I aggregated everything beginning in 2023. So I mean, it's we have a 10% compounded annual lead versus the S&P. I think it's like 45% overall. But I mean, I offer this caveat to subscribers all the time. I'm If I maintained a 10% compounded annual lead versus the S&P for 10, 20 years, I'm gonna like that is a goal that would make me so incredibly happy and ecstatic. But I don't think that should be anyone's expectation. The timing was pretty candidly lucky. So I get asked a lot, do you want to do are you interested in managing money? And the answer is yes, eventually. But I need to prove to myself that I can outperform across different environments, and not just outperform when things are really, really fun, and when the things that I'm investing in are going very, very well. So it's been a fun 3 years. I think this year's actually has not been that great of a year in performing exactly in line with the S&P. I don't own any of like the quantum or nuclear energy names that have really just exploded. But compounded returns are around 30% over that time period. S&P's at like 19.5 or something like that. Super happy with that. But just a large asterisk next to it. I think we just need more time to know whether or not this is real. It's kind of like a so far so good. But if anyone would be declaring victory, after 3 years of fun markets, and being in pockets of markets that worked really well, I think that'd be a little short sighted. And I'd like to see myself outperform during a rate cut cycle, during another rate hike cycle, during a recession, I'd like to see that aggregate outperformance happen in much more diverse backdrops, to start getting more excited about it, and stop being the I guess just party pooper who says, yeah, this is cool, but like don't pay much attention to it because we need more time.
Yeah, that's fair. That's fair. Go through some bear markets, right? Some choppy sideways years. We'll see what happens
Yeah.
during those.
Yeah.
For sure. What are you, I would say, actually, real quick, what sector or theme do you believe is the most mispriced for the next decade? And that could be most overpriced, most underpriced.
Oh, I think quantum is the most overpriced sector theme for the next decade for sure. I really, I mean, if you look at Bank of America, total addressable market estimates at 4 billion for 2030, and then you look at companies with market caps multiples higher than that right now, with businesses that I don't think are proven yet at all, with a lot more product market fit to create, with a lot more value creation to not to just yeah to create before you can even scale that and prove that it's commercially viable. And I think they're priced right now like that commercial viability has already been proven out, and like we're about to gear up for some massive rollout. So even after the recent pullback and recent decline, I think that's way ahead of its skis. Not to mention the fact that, okay, if quantum computing is super real, then do you think IonQ is going to win, or do you think Nvidia and Google are going to win? And I think maybe they'll buy IonQ, and then investors get a successful exit anyway, and it doesn't matter. But right now, I'm not a believer in quantum. I'm not a believer in that being a real industry for the foreseeable future. And I still find the valuations to be pretty ridiculous, even after the recent decline.
Got it. And then what about most undervalued?
Most undervalued. Um, I think, there's been so much negativity in the payment processing space. Is long. I mean, and I think PayPal's decision on the Braintree side, which Braintree, for listeners who don't know, massive competitor for Adyen and for Stripe. So those are really the big three in white label payment processing for companies. They've made a decision over the last 18 months to stop pricing like crazy people, to stop just undercutting people and accepting negative margin. And I think that's going to be so healthy for all three of these companies actually being able to fetch some kind of compelling margin. And they're all growing at a really nice clip. I mean, e-commerce transition, there are still a lot of verticals left that are in their infancy in terms of moving over there. And digital payment processing has a lot of growth left. And if that growth can start to be accompanied by a respectable amount of profit flowing down the income statement, I think there can be a re-rating in how people perceive these processors, and how people think of them as zero margin, dime per dozen businesses, because they're doing a lot to prove that wrong in terms of just pricing to value, but also layering on a lot of software subscriptions and just margin accretive tools on top of core transactions that are helping all three of these companies. Yeah, I would say payment processing is pretty exciting. Not pretty exciting, but I think it's exciting how hated payment processing is right now, because I think it shouldn't be quite so hated.
Got it. Got it. And then, kind of in line with the market outlook, we talked about the trends, right? Underestimated, overestimated. How much do you really pay attention to macro? Do you think it's useful input, background noise? How do you look at it?
Yeah, definitely deeply respect macro, and it's not I'm going to be 100% in the invested or 0% invested depending on what macro is, but sort of like you asked me about charts. If it's really broken, does that impact your process? And it's not like an all or nothing thing, but it's well, maybe I'll have 20% cash instead of 10% cash right now, and maybe I'll widen the bands on how much I need to see these multiples fall before I justify adding to them. So, in terms of right, we're in kind of a weird spot right now because employment markets don't look amazing, but we're still well in full employment territory. Like employment rates well under 5%. Inflation is still a little bit elevated, but it is in a non-linear way falling back towards 2%, or at least close to 2%. And then you think about the fact that, okay, the Federal Reserve is about to cut rates aggressively. Like Jerome might not do it, but the the next leader of the Federal Reserve under this president is going to be an aggressive dove. Like that is reality. And mix that with the fact that all these gigantic infrastructure deals from Korea and Saudi Arabia and all over the world pumping money into our economy, a lot of that starts happening really meaningfully in 2026. And then we flip from a fiscally restrictive policy framework to helping with $2,000 checks if that happens, or more stimulus, and just these cohesively blowing tailwinds on the monetary and fiscal side. It does create. I mean, valuations are a little stretched right now. I get that, and you can see that in how antsy and jumpy every single move feels right now. In terms of bubbles popping, or there is no bubble and parties on, and it seems like we cycle back for that every week. But there is a lot of support at our backs right now heading into 2026 that is going to that is probably going to help risk assets, even if the backdrop deteriorates, because money is going to get cheaper, liquidity is going to get better, and some of that money is going to flow into risk assets and support valuations. And how does that shape up on the tail end of 2026 as we move into 2027? And you kind of get to, okay, the inflationary impact of all this stimulus and all these rate cuts, we will see at that point. But heading into 2026, it just seems like the current administration is going to do whatever they can to support markets heading into midterms. And I don't want to be overly bearish as that's happening.
Yeah. I think it's a lot of good thoughts. We've covered a ton that I wanted to hit on. Last couple pieces here. Just kind of, are there any personal habits, routines that help you keep up, a high quality level of research and things that you'd recommend other investors, like just build these into your routine habit, daily, weekly, whatever it is, it'll make you a better investor?
Yeah, I love to run. I think that's super, just great for clearing your mind. Just especially when you're having a shitty day, getting on a I could say that. That's fine, right?
Yeah.
Shitty. Okay, yeah, yeah. Especially yeah, we're good. Especially when you're having a bad day, it's just amazing how that can really those endorphins can pump and reframe your point of view towards things. Especially for me, and I'm sure there are a lot of people like me who that you trade your own portfolios. You probably you have a pretty lonely work life, for lack of a better term. Like you work in solidarity, um, or solitude. Sorry, that was the wrong word. Wow, it's that brain fart. But you work in solitude, so the camaraderie is not really there very much, and you need to find a way to kind of distract your mind and pump those endorphins and get your I guess mental space sharp and yeah, sharp. And I think, I mean, we talked about my dad being my mentor and just really helping me through a lot of things. He is trying very hard to get me to start working, not in my apartment, because I mean, I'll wake up at 8 a.m. and I'll look down, not having moved at 7 p.m. I'm like, oh wow, that was kind of an intense day, and I don't think that's not a flex, by the way. I don't think that's a good thing. I don't think that's a healthy thing. I don't think that's an impressive thing. I think that is a almost not to be too hard on myself, but like almost like an immature thing where I need to you need to do other things besides working during the day in order to be more productive during the working. So for me, making sure I can put in these 80-hour weeks during earning season and making sure I'm fresh to respond to Discord chats, messages all the time in a productive way. It's important for me to have other things going on in my life besides work.
Yeah, I think that's a smart way to think about it. It really helps stay active 3 4 days a week for sure.
And
And
coffee.
especially, I haven't had coffee in a few years. uh,
Wow, that's impressive.
well, we get the bonus of I get the extra hours ahead here. It's like 1 p.m. here right now.
Okay.
So yeah, it's we get a little bit ahead. We can sleep in.
Yeah, that
All
is
right.
not.
Last two question, and it's a double. Last question, it's a double question. What is the best advice you've ever received about investing? And then second part, if you were to give one piece of advice to someone starting their investing journey today, what would that be? So these could be two different things, or it could be the same.
Yeah, I would say marrying your bull case. Being stubborn is extremely damaging to forward returns. You need, and I guess I'll answer both questions. And you need to be able to not well, you should, when you're rounding out a bull case, it's not just here's everything that can go right. You need to consider everything that can go poorly. And if someone is presenting you one of those things that can go poorly in a cordial and amicable way, and that's making you angry or sad or anxious, that is your mind telling you that you have more work to do, that there is more fortifying of that bull case. There is more to learn, because when someone presents a risk to you, you shouldn't get angry. You should think to yourself, yeah, I know, I read all about that last week, and I've considered it and baked it into my expectations, and I know. So do you have anything else to tell me? Because I already know. So like that is extremely important. And when there is something that maybe you haven't considered, because we are human and we don't know everything, it's so important to not respond to those people with anger and with hate and with aggression, but with curiosity, with okay, explain to me what you mean, and what do you mean by this, and here's how I thought about that. So now with this context, did that change your mind, or anything like that? So those conversations, especially for those people like me working in solitude where we don't get a lot of collaboration with coworkers, is so important. Is so important for it's almost like it's like a brain training, almost just making sure we're constantly going through that checklist for each bull case to give ourselves not only the confidence in knowing that it's still intact, but the comfort to know that we know when it won't be intact. Like we know when something will change, and we know when that change will be real or when it isn't real, because we've done the work. Arguments or debate is extremely healthy and extremely good. If you have inherent hate against short sellers or bears, which I am not, I don't short sell, so long only. I think you need to rethink that, and I think you need to listen to Michael Burry and listen to Jim Chanos when they say things. And maybe I don't agree with them on depreciation schedules or AI investments, or certainly don't think shorting Nvidia is a super prudent idea right now. But maybe you'll be right. We'll see. But I just think don't be pissed off at that. Learn from it. Be curious by that, and maybe you'll become maybe you'll develop a better sense of an opinion or an idea.
I think it's a very mature thought because most people, when someone does poke that hole in their investment case, they haven't done enough of the research to cover, and they just will brush it off and say, "You're just hating,
Yeah.
right? You just wish you
And
had a
guess
friend
what?
like me."
If they're right, and you then you're the amazing thing about public markets is I can hit the sell button whenever the hell I want to hit the sell button. So if oh man, I you don't like goodbye, sell, move on to the next one. There are so many public companies and great investments. You're not going to invest in all of them. So um, yeah, don't if you think they're right, say thank you. If you think they're wrong, say thank you because they helped you. They helped you. Yeah. So
Yeah, I agree. I'm on the same page with that. You can never have too much information from different parties just to bring to your table and continue to weigh. It's going to help you in the long term, even if it's annoying in the short term. So that is the message right there of the long term investing. Big thank you to you, Brad, for the time, the insights, contributions to the investing community that you've done. I
yeah.
encourage listeners. So there's a couple places where they can check out your stuff. At Stock Market Nerd on Twitter is a great place to start, right? And then where else should they find you? Substack, anywhere else?
Yeah, sites in or link to the site is in that bio, but it's just stockmarketnerd.com. And also I know, I mean, this is your viewership, so we're not like helping you grow subscribers, but just for people who listen to Wolf and there are so many people in our field on social media who don't do things the right way and in a stand up way, and this is one of the good ones. So if you are on Wolf's channel, if you are a fan of him, you have a good sense of who to listen to and who not to listen to because this guy rocks and his company rocks. So thank you for having me. I appreciate it.
I appreciate you as always. Looking forward to learning more from you on the timeline. Again, everybody, go ahead and give Brad a follow. More content to come here. He mentioned Brian Froldy. We'll have a episode with him out in a couple of weeks. We've got a few other special guests upcoming. Stay tuned for more. Thank you to everyone for watching. Wishing you a great rest of your ending out here 2025 and a great start to your 2026 investing journey. Take care, everybody. We'll see you on the next one.